this video, we're going to be talking about developing a personal balance sheet. Now, a balance sheet is probably a term you've heard before in the context of corporate finance, but the balance sheet actually has a little bit of importance with regards to personal finance as well. So in this video, we're going to be talking about developing a balance sheet, the key components that are listed on the balance sheet as well, and a little bit of the structure and kind of the breakdown and how it works. Using this balance sheet, we can do a number of different things, which we'll talk about in this video. So for starters, let's talk about what really a balance sheet is. This is going to be the focus of this video. And really the whole function or purpose of a balance sheet is it provides us what we call a snapshot of our financial position. Now, what I mean by snapshot is the information on the balance sheet changes over time. So as you accrue, let's say, more assets, or you accrue more liabilities, which we'll talk about momentarily, the numbers on the balance sheet change. And so it's always shifting. And so the balance sheet is only valid, or accurate rather, on the day that it's actually created. So it gives you a snapshot. But it gives you a snapshot of your financial position, sort of like taking a picture, how it preserves everything in its current state. But obviously, as time progresses, the information or what is in the picture, maybe it looks different than what it is 5 to 10 years down the road. So what we're taking a snapshot of are three specific areas. So the first area is what we call an asset. Now, an asset, more specifically, is something that we own that has value. So think about assets like the cash that you have in your checking account, or the vehicle that you drive, or the home that you live in. Those are things that are assets, assuming that you own them and no one else does. The other thing that's listed on the balance sheet are what we call liabilities. Now, liability is the opposite of an asset. It is something that we owe to someone else. So as an example before, we talked about an asset being a home. So a home is certainly an asset, and you can claim that value, of course, as the value of an asset that you own. However, if you have a mortgage that you pay on that, then obviously that would be a liability since you owe that to the mortgage lender. Another example would be a loan on a vehicle or a laptop of some kind, credit card debt. Those are all liabilities. Those are the things that we have to pay back, and they detract from what we call our net worth. The last component on the balance sheet, and really probably one of the most important, is what we call net worth. And this is essentially what we get when we take the value of our assets and we subtract liabilities. So using the balance sheet, we're able to determine, at least on paper, what our worth is by taking a look at what are the things that we own that have value and subtracting the things that we owe to other people. Now, that's the general structure for a balance sheet, but obviously there's more details that we're going to get into in the video. So if you look over onto the right-hand side of the screen, you'll notice that we have different categories under starting point assets. We have what are called monetary assets here. We have tangible assets, and then we have investment assets. And so we're basically taking the general category of an asset, which is something that we own that has value, and we're separated into three categories. This is important because although assets on paper are valued the same, when we look at our personal net worth, it's generally helpful to accrue more of a certain type than others, and I'll explain a little about what I mean momentarily. So let's start with the first one, and that's going to be monetary assets. Monetary assets include assets that can be easily converted into cash. So that means that whatever the asset is in, we shouldn't have a very difficult time converting it into cash relatively quickly. And so when you look at the things that are under monetary assets, you see cash that we have on hand, which cash is, of course, cash in itself, so there is no conversion necessary. We can spend it freely without having to do anything. We have money in our savings account, and that represents money that we have on hold that we can access fairly easily as well, and then money in our checking account. These all comprise monetary assets. Now, the value of monetary assets, of course, is they're easily accessible and they can be readily used. And so they certainly contribute to our net worth monetarily, but they have a lot of value for us too, because in the event that we have to pay for upcoming expenses, they can be used to cover those expenses.